Well, have a look at this slide. People say that the stock market is risky. Well, that is a myth. The reality is the behavior of the trader or the investor in the stock market is risky. So let me explain this with an example. So in our system, we follow three steps, right? In the orange trading system, step one is the high volume rally, step two is the low volume consolidation, and step three is the high volume breakout. That's the way we identify a trade. That's the way we identify a buy point. Have a look at this. We mark these points, okay, and point 1, 3, 5, 7, 9, these become your buy points. Whichever the lower, the better. Next, position sizing. Once you decide on your buy point, it is you who decides the position size. So if you decide that you want to put your entire portfolio in a single stock, that is your problem. You have decided to take a 100% position size. Similarly, if you don't keep a stop loss, that is your problem, right? There is a joke in the stock market. They say real men don't keep a stop loss. Okay. Well, those things don't work in the stock market. You have to work with a stop loss. Plus, there is something called as mental stop loss where you can choose these points as levels to watch. Okay, point 2, 4, 6, 8, 10. You can use these points as levels to watch. If the stock breaks that level, probably you might want to start cutting your position size. So there is no fixed guideline on mental stop loss, but something like this I use in my orange trading system. Okay. So in this, keeping a mental stop loss, the 8% stop loss, position sizing, this is all in your hand. Okay. You get to choose. So it is not the stock market that is risky. It is your behavior in the stock market that is risky. Okay. You have to control your emotions. You know this formula already. I have already made a video on this. Let's say the portfolio size is 1 lakh rupees. Position size is 6.25%. The stop loss or the position risk is 8%. Portfolio risk is 500 rupees. So 6.25 times 8% is equal to 0.5%. So the actual risk that you are taking on this trade is only 0.5% of your portfolio. So imagine taking 10 trades like this. Okay, 10 trades means you are putting 60.2, sorry, you are putting 62.5% of your portfolio uh, in the market, right? Still, assuming all 10 trades go against you, you will end up losing 5% of your portfolio, right? As per this. That means 95% of your portfolio is still intact. So even if you have 10 losses in a row, all hitting your 8% stop loss, you will still have 95% of your portfolio with you. Okay, so that is not taking on too much risk. Of course, I understand 5% is huge risk, but you took 10 trades. What's the probability that 10 out of 10 will go against you? Some trades will go in your favor, right? And if you are using a proper system with analysis, there is a good chance that you might have a 50-50 ratio, or even 30-70 ratio is good enough, okay, in trading, provided you are using a reward to risk ratio of 2.5 to 1 or 3 to 1, which we normally use. So if your stop loss is 8%, your selling range would be 20 to 25%. That's a 2.5 to 3, 2.5 to 3 reward to risk ratio. Okay. So have a look at this formula. This tells you that the stock market is not risky. It is your behavior in the stock market that is risky. Okay. You are only putting 0.5% of your portfolio at risk. Okay. And that too with the 6.25% position size. 6.25 is huge position size, very decent position size, right? Still only 0.5% of your portfolio is at risk. Moreover, if I multiply this by 4, 6.25 times 4 is 25%, and I divide 8% by 4, that's 2%. My product remains the same, that is 0.5%. Now, 25% is huge position size, but that does not mean that you have taken risk. You have kept a tight stop loss, right? So they also say that big position size means big risk. Well, that is not true. Big position size could be taken, but with a tight stop loss to manage or control your risk. Correct? So you have to decide the position size. You have to decide the stop loss or the position risk. That will tell you the total portfolio risk per trade. Very, very important point. One thing that you cannot control is the overnight risk or the downside risk. So, for example, if you look at this, if you take, let's say, 25% position and you put a 2% stop loss somewhere, okay, and suddenly after a day, the stock opens below your stop loss. That's called downside gap risk or overnight risk. That is something which is beyond your control. Okay. How do you mitigate that risk? How do you reduce that risk? Of course, you can't eliminate that risk, but there are ways to reduce or control that risk. How do you do that? Well, you do that only by investing in stage two confirmed uptrending stocks, right? In a confirmed stage two uptrending stock, the probability that the stock will create a downside gap is very low. Okay. And you have to be attentive to the stock and the events around the stock. So, for example, if you hold a big position in a stock and the earnings are going to get announced, you might want to reduce your position size just to control your risk. What if the earnings are not good or earnings are not in line with the expectations? In such cases, you might experience that downside gap risk. Downside gap risk is where the stock opens below your stop loss. So it doesn't trigger your stop loss. So it goes beyond your 8% or 2% stop loss or whatever. Okay. So you can control that risk. So it's your behavior that is risky. So if you control your behavior, you control your risk. Okay. Don't get carried away in the stock market. Next is taking 25% position size is not advisable unless there are all the odds are in your favor. So, for example, number one, you are taking a positional trade, which means the stock is fundamentally strong. Number two, you are already in a confirmed uptrending market. Number three, you are buying it in the early stage of its stage two uptrending advance, right? When all of these factors are in your favor, and number four, you have some realized gain in your recent 3 to 4 trades, you can use that money to finance the risk on this particular trade where you are taking a big position size, right? So when all of those factors come together, it allows you to tolerate more risk. It allows you to finance the risk. It allows you to take a bigger position size, okay, on that particular trade. So not on every trade you can take this. There are certain conditions which will allow you to take that big position size, and you need to be aware of those conditions. That is why education is very important. Okay. So let me repeat, the stock market is not risky. It is your behavior in the stock market that is risky. Thank you so much.